Hello, everybody, and welcome once again to the Master of Money program. I'm Steve Beeman, your host, and I'm very glad to have you with us tonight. We've got a great show. We're going to be talking about investment strategies, specifically how to use momentum in your investments to make them work a little better for you. We also, in the Master of Money program, have added a very special segment to the end. You're going to want to stick around and find out what we have in store for you tonight. Now, last week when you joined us, we talked about real estate, and we talked about how you can use it to generate nice capital gains for yourself, generate some income, and even get some really healthy tax benefits. In addition, we talked about how you could invest through ETF or exchange-traded funds, mutual funds, unit investment trusts, or directly into real estate, limited partnerships, all of which can possibly serve to build you a better portfolio. But we do want to reassert and tell everyone that when you're looking at real estate investments, make sure you remember that your home is your biggest investment, and that is in the real estate category. In fact, today on Newsmax television, I was talking specifically about Americans' wealth and how the real estate bubble that burst in 2009 has been a demonstrable problem for most of us. So stick around for more information on that as we go. But let's go back always and remember that real estate can, in fact, be part of your portfolio. Now, we do ask each and every week for you to write us at questions@safefinancial.org. That's a website or an email that we use to get questions from viewers just like you. We find each and every week more and more interesting ones come in. And this week, the question I want to answer is one that we could do a whole program on. But I had a gentleman write in and say, how can I plan? How can I develop a plan for my retirement? How do I know how to calculate what I need? Well, this is a question I've worked with people on for 30 years. It's actually relatively simple. It's the discipline in getting there that makes it hard. Well, I want to take a look at some things tonight to give you a bit of a plan on that. And if you're beginning your retirement planning or you're into your retirement, this is information that ought to be second nature to you as you go forward. Let's accept some facts as we begin, though. Most importantly, life expectancy has dramatically changed over the last 40 years. In World War II time periods of 1940s, people retired at 65 years old, which, according to statistical tables, was their life expectancy. Well, in today's world, with advanced medicines and a healthier lifestyle overall, the average life expectancy for a child born today is approaching 90 years old. Well, most of us aren't going to live healthy till 90, although I wish I would. But we have to be prepared to work further into our lives to make sure that the nest egg we build is big enough. So the first fact to recognize is that 65 as an arbitrary age of retirement, well, that may be a thing of the past. We may look to something more like 72 years old now, which is probably a better number to target for your own retirement. As we talk about medical technology, it's important to note that with that medical technology comes cost. So as you plan a retirement now, where it used to be not that heavy a component, medicine to keep you going and to keep you on a happy and productive life will cost increasingly large amounts of money. So you need to build that into your retirement plan. So we're going to take a look at some statistics. Some of those include the national retirement plans. Most of you are familiar with Social Security and Medicare, and I get questions all the time about whether those programs will be there when someone retires. Well, let me tell you the reality of it without the political spin. Yes, it is true that Social Security can be in trouble, but with a few very minor changes to the Social Security program, that program will live much longer than you or I. The reality is they probably will raise the retirement ages. So we're at 65 now. Let's look possibly at 67 for those that are below 50 years old. And again, moving toward that 72 years old for new entrants into the system. In terms of Medicare, well, Medicare today is fine. It's underfunded, yes, and there is what's called a deferred liability. But as the economy grows and as things grow, Medicare in all of its forms will likely be there for the foreseeable future for retirees. So I wouldn't be overly concerned about not getting your benefits from those programs. There may be tweaks to them. There's talk in Washington, for example, of taxing some of those benefits to the more well-to-do. None of it's going to take the money away. It may just change the way it's structured. But it's important for you to know that the money you can expect may not be as great as you thought it was. In retirement planning, there has been forever a rule of thumb that if you build enough assets, that you can withdraw 4% a year from those assets to get the income you need, then your fund would last in perpetuity. Well, that's been an interesting historical rule of thumb, but it's also been a rule of thumb when interest rates have been greater than zero. Now, many retirement funds, especially as you get older, that are invested in bond funds and things like that, you're not making 4% a year. So we need to rethink that rule of thumb as well. These are facts that we all need to consider as we approach our retirement plans. The other number that I hear all the time is that when you retire, you'll require about 80 to 90% of your current income. Well, I don't know about you, but I've spent time in pseudo-retirement, and I found that when I had more time on my hands, I spent more money. So you might be looking at your retirement funding thinking, well, I want to target 100% of my last income, or even a little bit more. The fact of the matter is, having time on your hands can be a good thing, but you want to have the resources to enjoy that time as well. So let's look at some numbers. The average American earns between $50,000 and $60,000 a year right now. So if we apply an 80 or 90% rule to that, you're going to target somewhere around $48,000 a year in income. Well, that may not sound like a huge amount, but let's look at how you get there. There are a couple of components that are important. First of all, Social Security, which, as I said, I believe that most of us will reap the benefit from. We've saved that money. It should come back to us. Well, the average Social Security benefit runs about $14,000 a year. Now, if you've maxed out your contributions, meaning that you've hit the maximum level of Social Security contributions every year, you might get up to more like $20,000 or $24,000. But for most of us, that number is going to be around $14,000 a year. So if you think about it, that leaves about $33,000 that you're going to have to make up from your own resources. These are sobering numbers. Let's take a look at what that means. If you think about $33,000 and we apply that 4% rule, and again, that number may be suspect, but let's use it just for discussion's purposes. That means that you have to have private retirement resources averaging about $560,000 in order to generate that $48,000 of total income, Social Security component as well as your own. Now, for many of us, that may not be a big problem, but for the average American who has $80,000 put away toward their retirement, including their home, that's an awfully big nut. So let's take a look, if it's such a big problem, and let's look at solutions. How do we go about solving this impending retirement crisis? Well, there's some thoughts. First of all, some really simple ones. We need to learn to save more. We need to get out of the consumption society and realize that having capital, that is savings, is what's necessary for us to get there. So the first rule is to quit spending, start saving. The second rule, of course, which is common sense and talked about by the Dave Ramseys of the world and the Susie Ormans, get out of debt. The fact of the matter is, we've spoken at length in The Master of Money about compounding and how it can affect you for the good or the bad. When you hold debt compounded against you, that can be a number one cause of not building the retirement you want. So focus your numbers on getting out of debt and controlling the outflow or the spending side of the equation so that your saved money or your capital improves. Now, once you've done that, I believe it will become fun for you, and you'll learn to evaluate your purchases not on what they cost you today, but what they might cost you down the road. Now, I've been accused of being kind of fanatical about this before. I told one of my children once that a hamburger today might sound good to them, but that $1 hamburger is the equivalent of about a whole week of groceries 10 years from now. Now, they didn't take kindly to that, of course. They wanted the hamburger. But the point being, we need to all think about what we spend versus what that money will be worth in our less productive times. The other things we need to do is to become a master of money. We created this program and we started the society because we see this problem coming at us like a freight train. The only way to solve it, the only way to help you build a better path to prosperity is for you to have the knowledge and the tools that you need to understand what to do with your capital once you've saved it up. Well, it's important to understand the types of investments you can do, what to look for in good ones and avoid in bad ones. The society was built to help you understand those issues. And again, we urge you to write us at questions@safefinancial.org or visit us on the web at safefinancial.org as well. We want to help you, and we exist to provide you a counselor in the financial services industry. Now, each week, we go through the geopolitical and economic events to give you a perspective of what's going on around the world. This week, it was an important anniversary, the 25th anniversary of the breaking down of the Berlin Wall. Now, some of you are old enough to remember when that historic event happened, but the fact of the matter is few of us recognized at that time the type of geopolitical consequences that would come from it. From a relatively stable world with a bipolar power structure of the United States and the Soviet Union, we have devolved as a world into a system of very many power systems. China as an up-and-coming neighbor, Russia certainly calling back the empire, Europe and the European Union, South Asia, Africa, the Middle East. All of these areas now have changed as a result of the breakdown of the Berlin Wall. Well, as you look around the world at the development of opportunities for our economy or threats to our freedom, that breakdown of the wall is a critically important piece of the pie to understand. We also did see of high importance this week Mikhail Gorbachev, former chairman of the Soviet Union, who was instrumental in the breakdown of that wall, coming out threatening us in effect with another Cold War. Now, you're involved, you see the news. Many of you are aware that we're already close to a Cold War with Russia. But Gorbachev was saying that the United States took a winner's attitude about the Cold War, and in doing so has actually threatened the global stability order. Well, I don't know that he's right. I don't know that the United States is the cause of the current problems in the world, but we do want to keep an eye on what's going on in Eastern Europe, specifically the Ukraine. We've spoken about that before, to make sure that going forward, as it relates to our path to prosperity, we're positioned to make money on transitions, not get hurt. In the economic news, global banks were called upon by Janet Yellen, chairman of the United States Federal Reserve, asking them to provide more stimulus to their economies. Well, clearly the reason for that, and we've talked about this here on the Master of Money, is that we've seen a slowdown in the European and Far Eastern economies in the last months, all the while the U.S. economy seems to be picking up. Well, we don't want to see those economies take us down, so our Fed chairman was on the road again begging those central banks to provide liquidity. Now, at the same time, our Federal Reserve stopped their quantitative easing program. We talked about this a little bit last week. The Federal Reserve said with our economic growth, there's no more need for them to be buying government bonds and adding cash to the economy. Well, that's a good sign. Now the question will be whether or not the Federal Reserve can unwind the $3 trillion of new money it's created as they go forward into 2015. This is another reason you need to watch the Master of Money, so we make sure to keep you involved as that unwinds. And yes, that will hit your investment portfolio. Just today in our Safe Insight, we talked about the impact of rising interest rates. We'll talk about that in another Master of Money program, but it's a critical thing for you to understand, especially if you're at an age where retirement either is in play or is shortly looming. So stay tuned for more information on that. We have continued to see as well oil prices staying down. They peaked at about $103 a barrel a while back and have come down to around $80. Now, for you and me as consumers, that's a good thing. We've seen prices come down at the pump off of those $4 levels down around $3. Puts more money in our pocket, and it transitions money out of the energy sector into the consumer sector. Now, if you pay attention, it might let you save a little money too. But those oil prices, nonetheless, are creating problems around the world. Single-source economies like Russia, Venezuela, Iran, Saudi Arabia, those countries with these depressed oil prices are having real problems. All of that throws into the chemistry of the global economy, and that's part of the reason that it's slowing down for them. Well, now with our shale oil production and our virtual self-sufficiency in oil, we don't have those problems because we have a big, broad economy. But we are affected by the globe, and you need to make sure that where your money is invested will realize a positive outcome from global positioning. Now, in the financial markets, we saw last week the major markets continued their rebound. We're seeing the volatility, certainly. There's a lot of fear that stays in the marketplace. The reality, though, is corporate earnings are up, American business looks cash strong, and that's keeping stock prices high. Not to mention the fact that the Federal Reserve continues with a zero interest rate policy. Now, when you look at zero interest rates, would you rather put your money in a bond or a stock with good earnings? For me, I'd rather be in a stock with good earnings. Now, that may change as interest rates go up, but right now it's continuing to sustain a very strong stock market. Now, each and every week we try to find something interesting for you, and this week had so many little interesting tidbits. But I wanted to talk about a company that I spoke on the news about not too long ago. We talked about the globalizing of the markets and how American brands sometimes, for example, 7-Eleven, are owned by foreign companies. Well, there was a lot of press about Burger King a few weeks ago, and Burger King this week announced for the first time it was entering India. Yep, that famous burger company, number 2 only to McDonald's, is attacking that land. I won't say down under, I think that's Australia, but that land that has for so long had a hard time feeding starving populations. Hopefully, Burger King's move will bring some ability to feed those people, and it would be nice to see a little more growth out of India as one of our markets we can serve. So we wish the very best for the Burger King, even if he stops those absolutely hideous commercials. Now, tonight, we're going to begin discussing investment strategies. Specifically, we're going to talk about momentum. Now, this is something that's often used to juice up returns. We're going to talk about how that's done. But used improperly, it can really hurt. So we want to talk tonight about momentum in all of its good, bad, and ugly, and make sure you understand how it can be used for your portfolios. We want to talk about why they're so widely used, how they're so widely used, and how the real institutions use them. So this all is generated to help you capture superior returns. So sit back and relax tonight. When we come back from our short break, we're going to talk about momentum strategies and how they can help you build a better portfolio. We'll be right back.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the Master of Money program. We're glad you're with us tonight. Hopefully, this is going to be a program that can change the way you think about investing, and we want to give you a broad array of ideas that you can use to build that better path to prosperity. When we look at investment ideas, the fact of the matter is there are as many investment ideas as there are investors. We have people that you might consider fundamentalists, and these are guys like Warren Buffett, who learned from Ben Graham, the famous author of the book back in the 50s that talked about cash flow investing. These people look at the fundamentals of a business as to whether or not it can generate strong earnings at a reasonable valuation for a long period of time. Sometimes they're considered to be foolish. Warren Buffett came out today and talked about his Burlington Northern investment. He bought into that railroad a few years ago and everybody said it was stupid. Well, the fact of the matter is Burlington Northern has been a cash king for him for the last couple of years, and it looks like it will be for a long time. So you can't argue that some of the fundamentalists do quite well. The second group are people that I would call thematics. And these are people, you may know the name T. Boone Pickens. These are people who, within a theme of investments, make their money. T. Boone was a big oil man, so he made investments in oil and silver and commodities. Other people do this with Globe. They may want to buy into the global retailing business or the global exploration business. The thematic investors usually have sectors or industries they're involved in. And again, that takes a great deal of in-depth knowledge on what you're doing. Otherwise, those in the know will take you to the cleaners. So the fundamentalists and the thematics are complemented by what I think of as the behaviorists or the technicians. These are people like Steve Cohen, a famed hedge fund manager who become very experienced at playing short-term trades in the market. The technicians of the world follow the price charts very closely to determine exactly where you're going to invest. Their belief is that prices determine everything in a stock, and as a result of that, they try to bet those charts and make them work. Now, there are also subcategories of these various stocks, and if we look, for example, there are value investors, there are growth investors, there are momentum investors, which is what we're going to focus on tonight. But in addition to that, there are people that are called event managers. And if you look at the institutional investment world, those who invest in these hedge funds, a lot of those are event driven. And what that means is they're trying to find an event around the world that can occur with a predictable outcome. I think the best example of that was the early 1900s earthquake in San Francisco. Most of you wouldn't know this story, but back in the early part of the 1900s, San Francisco experienced a big earthquake. Well, this is a day before telegraph lines, so communications out of San Francisco weren't that strong. Well, it just so happens that one person did have a wireless communication capability. His name was Edward Hutton. Now, the fact is, because he was able to communicate, it worked really quite well. And he was able to make a fortune because that event was very predictable in its returns. So it worked extremely well for him. And that's true of many of the event-oriented investors. Now, the other category that we want to spend time on tonight is momentum. These are people frequently thought of as technicians, but there's also something that I think of as fundamental momentum. It goes back to an old adage in brokerage: the trend is your friend. You don't want to fight the trend, folks. And if you can capture a trend on its way up or on its way down, you can use that to both buy superior returns as well as avoid major losses. So these are important things for you to know, and that's why tonight's program is so important. Momentum, thinking about it as the speed at which something moves, could be the speed of the earnings, the speed of the price, the speed of the value, just the change over time in those variables. The important thing is it can capture psychology. And in the market, few things are more important than investors' psychology. So momentum, when added to a strategy, let's assume for a minute that you're a value-oriented person. In other words, you like to buy things on the cheap. That's fine, But you don't want to buy things on the cheap that are going to stay cheap for a long time. You want to buy things on the cheap that are going to expand in price. Well, momentum strategies can help you do that. Similarly, you may be a person that believes that you don't buy value necessarily. You don't want to buy it on the cheap. You want to buy things that grow. You want to buy the next Apple computer or Microsoft. That's wonderful too. But there are times that you look at growth companies as an example, and they won't move. They'll sit there because it may take longer than you think for growth to materialize. Well, the fact of the matter is, momentum can help a growth strategy as well as a value strategy. And one of the things I've talked about often in my institutional work is the need to build a sell discipline. It's funny. You look at institutional investors, and the bulk of the research they get is on when to buy a stock. There's very little on when to sell a stock. But momentum can be very, very useful for you in building downside protection to your portfolio. Now, I wrote today in our Safe Insight about interest rates, and we spoke about that a few minutes ago. If interest rates move up, you will see the market come down. There's an inverse relationship between interest rates going up and the performance of the market. Well, momentum can help you avoid a big loss when that turn happens. So you want to be familiar with not just price momentum, that is how fast the price is changing, but also earnings. A company whose earnings are rising in the near term typically will outperform the one who isn't. So you want to be conscious of momentum as it plays out both in your stocks and in the market as a whole. Again, we could get into much more depth into this, but unfortunately we're limited to a 30-minute program. But as we go forward in the Master of Money series, we will produce more and more content for you on how you can use momentum. Now, as I said, it complements virtually any strategy. Whether you're a value investor or a growth investor, momentum can add some juice to that return so that you don't sit on dead money and you don't wait too long to get out of money. So playing into that adage of the trend is your friend, well, that's important, and never forget that. It's one of the simplest rules of thumb in the business, but I'll tell you what, it's one of the rules of thumb that plays out time and time again. So let's look at momentum as a rule of thumb trend following thing. Let's look at it for downside protection, and let's look at it for the ability to complement the other strategies you do. Very, very important for you. But let's talk about some things that are related that get into the nuts and bolts. How do you define momentum? What is it? A lot of people think about momentum as just the price. If the price is rising, there's positive momentum. If it's declining, there's negative or downside momentum. Well, that's true. I wouldn't deny that. But there are other things that have momentum too. I mentioned a company's earnings. Well, there's momentum to that. Some companies have rising earnings. Some companies have declining earnings. There are companies with positive sales growth, positive book value growth. There's momentum in any of these characteristics, and it's the relationship of those that usually differentiates between the winner and the loser in the marketplace. Rarely is something as simple as, oh, just watch the price. Usually there's much more to it. For example, what made that price move? Well, these other variables that occur within a company and you're investing in, they affect that price. So you need to be conscious of the momentum of the things you're buying if you're managing stocks yourself. Now, one of the things we're going to talk about in a minute is how you can have others do this for you. If you're one of those people who just doesn't feel comfortable managing your own assets, there's nothing wrong with that. There are lots and lots of ways to hire other people to execute your beliefs. So as you're looking in your portfolio, maybe you want to look for some ideas that add momentum into your portfolio. Now, the other question, though, if we look at it, I'm digressing, but how do you define momentum? The second derivative of that is how do you know when momentum is established? I'll tell you a true story. I've seen time and time again people working with these trading systems. You've seen them advertise, put in $1 and make $1,000 back. Well, the fact of the matter is all of these systems are trading on trends. Well, the problem is that it's extremely difficult with some of these short-term indicators to know when a trend is really established. It may very well be that that stock is going up and it's in a positive trend, but it's going to break shortly and start to come down. Well, the systems frequently will tell you to get out of the stock. The system's not wrong. But human nature makes you and me not get out when we should. We look at the momentum and say, oh yes, it broke, but it'll come back. Or we look at a stock that's gone down and has negative momentum. Oh no, it'll come back. I'm not going to get out of the loss. Those emotions are what make us lose money in the marketplace. And they're captured by the people who understand momentum. So if you're thinking of investing your own money, take a quick self-evaluation of your psychological ability, I guess, to ignore your psychology and face the facts. Momentum, more than anything else, can move for you quickly or against you very quickly. Now, this next chart you're looking at on the screen shows you some of the strategies that haven't been so successful. This isn't a panacea. It's not the end-all, be-all of investing. Yes, it can help, but it's not going to always win the game. This next thing shows you 4 or 5 different funds that have run off of momentum strategies, and if you look at their 15-year numbers, they're frankly not all that good. The best one out here, which is the no-load aggressive model portfolio by Janet Brown, has a 12% return on average over the last 15 years. That's pretty darn good. More importantly, though, take a look at the standard deviation of that one. Now, we talked last week about risk and beta and standard deviation. Well, she has an equivalent to the market variability. So with that strategy, you're generating a better return than the market, but the same volatility as the market. Not a bad return. Many of the others, though, if you look at Bernie Schaefer's option advisor, my goodness, in the last 15 years, that's averaged a whopping negative 15% return. Not healthy. And look at its volatility, twice the market. So these are characteristics you want to look for, not just positive return in the track record, but also the variability in what's called the drawdown, or how much they lose in their worst scenarios. So these are just some ideas. And if you look at why these don't work, well, frequently it's a poor, what I'll call real-time understanding of momentum. A lot of times investment systems, and again, you may have seen some of these advertised, work in history in what's called a back test. They look in the rearview mirror and say, wow, when that price goes up this many days, it tends to stay going up. And in the rearview mirror, it looks great. The problem is, in real time, that doesn't always play out. So you need to be extremely cautious if you're going to use a trading system that's momentum-based, that looks good in the past, that may not look so good in real time. And then secondly, is the lack of embedded risk controls. We frequently see strategies that don't use adequate risk controls, and when momentum turns against you, it can do so quickly. So whether you're buying your own stocks, you're investing with a mutual fund, an exchange-traded fund, or an advisor, make sure that you've talked about the risk controls that are embedded in the process. It's very important because oftentimes it's not how much you made, it's how much you lost. And that's not a pleasant thought for any of us. So not all ideas work. Are there good ones? You bet they are. But those good ones understand the real-time performance of momentum. They're usually a little more complicated than just price charts. And they understand when to execute, and they do execute when the system says to do so. You don't want to be caught in a trap where you say, oh, I'm going to invest my own money. I don't have enough. I looked at that $500,000 and I'm not there, so I'm going to shoot for the stars and I'm going to buy one of these trading systems and wow, I'm going to make 100% a year. Sorry to tell you, no, you won't. The fact of the matter is those systems make money selling the systems. If they worked so well, the owners of the systems wouldn't sell them. So don't get caught up into the momentum trap, looking at all of these great, wonderful returns you can have. Be realistic. If the best one we just looked at was a 12% a year return, and that's about 50% better than the market as a whole, isn't that a pretty good benchmark for how well you could do if you had the best strategy? Food for thought. The fact is, it's never as simple as it looks. Now, I mentioned you earlier, we have a special part on the program today, and we're going to talk about a very special, what would I call it? I guess just part. We've now partnered with Superstock Investor, an institutional grade research firm, to bring you the Superstock Stock of the Week. And we're very pleased that each week going forward, we will bring you a very specific stock idea in the hopes that it will help juice up your returns. This week, this chart that we're going to put up right now looks at Ford Motor Company. This was a bit of a surprise when I saw it from Superstock, but the fact of the matter is the folks there looked at its earnings, its valuation, its momentum, all of the above information, especially with how much it's traded down. From that chart, you can see it's come off of a peak at 18 down to $13 a share. We believe this is just a technical move. Superstocks put a high-end price on this stock at $22 a share. Now, this may or may not be suitable for your investment portfolios, but you want to take a look at companies like this, and each week we'll bring you a new one. This next table that I'm going to put up for you shows some of the fundamentals. Again, you can see the current price at $14, the price target at 18, which is a gain of 32%, the upper limit of 22, and the lower limit, they believe, of 15. Now, is Superstock Investor always right? No. But I've known these guys a long time, and their research is very thorough, and their hit ratio is pretty darn good. So as you look at your portfolio, it may very well be that an investment in Ford Motor Company could work for you. Thank you to our friends at Superstock Investor. If you want to visit them at Superstock Investor on the web, tell them the Society sent you. I'm sure they'd be happy to work with you and give you more ideas than just the one a week that we will. So tonight we talked about several things that can juice up your investments. We talked about momentum as an overall strategy or an overlay onto your core fundamental strategies. This is important, and it's a key part of your improving your returns. We talked about putting risk controls on your investments, and boy, should you have that. If you look at the Federal Reserve's comment this last week, it is likely they will start to raise interest rates in early 2015. When that happens, stock prices will come down. Now, the reason for that isn't insidious. Think about it. As rates go up, bonds become more attractive. Well, that means money will come out of the stock market into the bond market. Well, you ought to have risk controls on your stock portfolios to prevent you from taking a big hit. Talk to your advisor about it. Again, the Society doesn't exist to be an investment advisor. We exist to educate you and to provide you all of the information you need to make the best decisions for yourself. So talk to your advisor and make sure they're putting those risk controls on for you. And as always, we welcome you to write us at questions@safefinancial.org. That's an email that we take directly. We evaluate the questions, and we try to bring one to you each and every week. The Master of Money is written and produced by the Society to Advance Financial Education. We're a not-for-profit organization built to provide you a friend in the financial services industry. The fact of the matter is, with globalization, technology growth, we're seeing changes like never before. You need a counselor. You need someone you can trust to sit down with you one-on-one and give you the insight and ideas you need to build a retirement for yourself, a college plan for your children, or anything else, just to make sure you have an insider in the market who can take you through these very murky waters. Let the Society be there for you. Visit us on the web at safefinancial.org and join us. Become a silver member. It costs you nothing. Sign up and you'll get access to our I won't say daily, but periodic Safe Insights. These are 5-minute recorded broadcasts that cover very important issues in the marketplace. So sign up today at safefinancial.org. We look forward to seeing you next week as we prepare another issue of the Master of Money. We're going to leave the topic to be a bit of a surprise. I'm excited about it, and I think you will be too when you hear it. So join us live next Tuesday evening for the Master of Money program.